So, wonderful, good afternoon. Loud enough? Or too loud? It's echoing, isn't it? Better? In the last row, everybody can hear me? People on the phone, last row? Either this, you can hear me well, or is it too quiet? Hello, the last row over there. Can you hear me well? Good. Because I was told I was too quiet last time. You have to tell me during class, right? I can't tell how well you can hear me there in the back. Good. Before we start with topic 5, let's catch up a little bit on topic 4 from last week. So, now on the left, okay. Last week we talked about securitization. That was the trickiest part. Good. And the trickiest part about securitization was that we do tranches. And when we do tranches, we don't sort the loans into good or bad loans, but we just say who's getting paid first, who's getting paid second, who's getting paid third. That was the trick here with the tranches. Now you might wonder, well, in the end, we're selling all these mortgages via the SPV, special purpose vehicle, via tranches to some other people. Why do we even do it? Why do we even sell the mortgages? There must be some kind of advantage of doing that whole business here. And that's where we were a little bit fast with last time. So what's the advantage for the originator? That's the initial bank who've created the first mortgages and then sold them on later on. Now, one advantage is instead of waiting for 30 years till you get your money back, you get paid immediately. And you get paid the present value of all the future profits that you might receive too, immediately. So you have immediate income, immediate profits. First advantage. Second thing, you can still specialize on what you're good at. You're good at evaluating if people should receive a mortgage or not, because you're a bank, you're specializing in this. If you keep all the mortgages on your books, there's certain bank regulation, which we will have in week 8 and 9, I think, which is saying your bank is not allowed to go too big. You're not allowed to have infinite amount of mortgages. So by getting rid of existing mortgages, you can replace them with new mortgages. And you can keep on doing the evaluation of these mortgages and also keep on earning money by several things. So servicing the underlying asset here basically means that you still collect the mortgage payments from the house owner and just channel this money through to the SPV and then to the different tranches. And for that one, you collect a little bit of a fee. So you're earning money there too as a bank. Good. I said this one already. So future income is basically paid immediately via present value. Credit risk. So if you have the mortgages on your book, on your balance sheet, and the house owner goes bust, that he's not able to repay the mortgage, you as a bank have to cover the losses. So you suffer from these losses. But if you sold all these mortgages to somebody else, then if the house owner goes bust, that's not your problem. It's a problem of the other people. Because you promised them, you get those cash flows. If these cash flows dry out, if the house owners don't pay because they go into default, that's not the problem of the bank, that's the problem of the people that bought these different tranches. Now these different tranches go bust. And remember, we did this game last time, how they're affected. That's exactly what can happen, and that's exactly also what has happened during the global financial crisis, which we'll talk in more detail basically in one of the last few weeks in this class. What else is an advantage here? Let me see if I got through all of these. So default risk is pushed away. Ta-da, we got that one too. So that's basically all the same. You put the default risk onto somebody else. It's to a certain degree, you might argue it's cheaper. Nowadays, of course, it's not that cheap anymore, but in the past. So people did like to buy these AAA tranches. They're willing to pay a very high price for it. And a very high price is the same thing as saying very low yields. So you had to pay them very low interest rates in that sense. So banks received a lot of money for selling these mortgages, meaning getting money for new mortgages was easy for the banks. That's what's meant here by cheaper funds. So these are all benefits for the bank. Then there's a little trick here too that is not necessarily for the bank, but for other companies, why they may do tranches. Let's imagine, for example, here they've got it as an example, a bank. Let's say you're a B-rated bank. So your bank is not the best. They say there's a chance that they might go into default. Usually if you borrow money, you have to pay the risk premium of a B-rated bond. So you have to pay much higher interest rates than the government or much higher interest rates than a AAA rated company, like for example Apple I think has a AAA rated. They get very cheap funding from the market when they issue their bonds. If you're a B-rated company, you have to pay higher interest. But if you're a B-rated company and create a securitized pool of assets in this case here, and then create AAA tranches. The AAA tranches are now considered very safe, and that means the interest rate on them is very low. So that's a trick to get a little bit cheaper funding. But the question here really is, of course, really what you do is reshuffling the risk. You've got the overall portfolio of some assets or some mortgages, and you promise some people with the AAA tranches, you get the first money. But therefore, some other people get money last. That means that AAA have very, very low risk, but therefore the lower tranches get a much higher risk. The average risk across all tranches is, of course, staying the same. Right? Because the average risk is still the average risk that, well, there's cash flow coming or not, right? So if you take the average amount of water that comes across all three tranches here, that's of course simply the amount of rain. Right? If you have one big bucket or three small buckets, the overall amount of money and water here doesn't change. What only changes is the distribution between them. So you make some buckets safer and some buckets riskier. But of course I did some tricks on these two so that overall it paid off for them as well. Now, what are other things here that are an advantage? We can reduce the regulatory capital. So this is really something that you should keep in the back of your head because we haven't talked about capital regulation yet. That is coming after the mid-semester break. But securitization used to be a trick to get around regulations. For the investor, so why do people buy these tranches? More diversification. For example, if you are in Australia, but you want to be exposed to the earnings of the American housing market and also possibly of the risk of the American housing market. Remember that risk can be that you're losing something, but risk can be also something that you gain something, right? Risk goes in both directions, not only in one direction. So people all over the world did like to buy American securitized mortgages because it's helping them to diversify their portfolio, right? You know that you should not put all eggs into one basket. You should buy lots of different things. And these securitized products were simply an additional product that you can put into your portfolio and diversify your portfolio. Hence, the whole world liked to buy these. Different tastes for risk, so you can see, just like last time, you can kind of customize the risk. If you want to have high risk, you just buy a B tranche or an equity tranche. If you don't like any risk, you buy a AAA tranche. And because they are tradable, these securitized debt, you can buy and sell them. They're more liquid. So you can sell them in the past fairly easily in the secondary market. Benefits for the borrower. Let's cancel this one out. We don't need that one. Benefits for the financial system. So here, before we had the financial crisis, people did like securitization. And I said, this is fantastic because we spread the risk now much wider across the system, which is a good thing because we're sharing the risk, and risk sharing is good in the sense that we don't have risk clusters somewhere. And also, we give people simply more chance to go from the deficit units to, no, the other way around, from the surplus unit to the deficit unit. So in the past, it would have been almost impossible to connect a German saver or an Australian saver with an American house buyer who is a deficit unit. But now we have these securitized debt. It's much, much easier, right? Because all over the world, people can buy these securitized debt. And the funds, in the end up with the American house buyer. So it's more efficient, better channeling of funds. But the question is if that really worked out well. Apparently not, because we had the global financial crisis. So there's certain risks there as well. So of course, the upside is that we spread the risk further. On the other downside, well, the risk might spread to areas where people, for example, don't really know very well how much risk there is. And especially here with the tranches made it much harder to see actually how much risk there is. That's the reason why we did that math example last time in class. Remember, where there was just a change of, so we changed the default rate from 5% to 12%, which doesn't sound like much of a change. Right? Instead of $5, you lost $12 on a $100 portfolio. But if you had the triple B tranche, it turned out that you lost everything. It was much more of a zero, all or nothing decision there. So the risk is totally different. And that is a relatively simple example I gave you here in class. You can imagine in the real world, they made it much, much, much more complicated even. Because what they did is not only did they do the tranche once, but then they used this triple B tranche here that we just calculated here. So that was already a bit tricky. And mixed that triple B tranche with lots of other triple B tranches. They got from other banks, from other areas, from New York, Los Angeles, Las Vegas. They mixed all of them together in a portfolio with hundreds of different triple B tranches. And take a guess what they did then. Once they've got this new portfolio, they sliced that into new tranches again. And I said, well, out of that old portfolio, the chance that all the 100 different tranches go bust at exactly the same time is most likely close to zero. There's always some money coming in. If there's always some money coming in, we can create again a senior tranche. So if you have 100 different triple B tranches, you can make a new triple A tranche out of that one. That is this one here. And then the leftovers become Bs again and equity. And that is called, oh sorry, here, CDO. And then you can do the same thing again. So you take the lower tranches here, buy lots of different ones of them, mix them together, slice them again into new tranches. But you can see how difficult it is to calculate the real risk that is behind that one. Almost impossible. Right? And that's the reason why people really mix these things up. And I can highly recommend the movie The Big Short is the best one for that one. And that one, they show that very well too. That's exactly what I've got here on the slide, is what they're talking about in The Big Short. And if anybody watched that one, the movie, The Big Short, where they have that Jenga tower and they start pulling things out, that's exactly what they did here, right? So they started pulling things out of these tranches and saying, well, they start going bust and bust and bust. And what happens then is the whole tower toppled, meaning they got paid, just as here, nothing. So something that used to be triple B or possibly even triple A, like these guys, triple A, all of a sudden become worthless. Because these triple A were built on these triple B. And the presumption was it's very unlikely that all triple Bs go bust at the same time. It's very unlikely that the housing market in New York, Las Vegas, and San Francisco is going down at the same time. That never happened before. But of course, it did happen then. And then none of these tranches is paying anything. Just as in our number example here. All these triple B become to zero. And if all these triple B become zero at the same time, what happens to the triple A? no money left. So it said AAA, but all of a sudden people lost everything. That's roughly what happened after or during the GFC. Good. I think that's everything that I want to get out of last week's class. My tutors alerted me that some people get a bit nervous, that my timing is sometimes a bit off in class, right? So some slides I'm running over quickly, some slides I'm spending lots of time on. I can calm you down on this one. Just remember who's designing the exam, right? So if I'm going fast over certain slides and spend a lot of time on other slides, that should tell you something already. If I'm saying the slide is not important, it's highly unlikely to impossible that it comes up on the exam, right? And there's a reason why I spend lots of time on certain topics, because certain topics are harder to understand, and it's more important to me that you do understand them. That's the reason why I spend so much time on it. And unfortunately, I'm sometimes too ambitious and give you too many slides in the beginning. I should delete more slides before class. Good, that's what I wanted to do as catch up from last time. Let's move into today's class. Topic 5. Let me see if I can do full screen. That's a bit nicer. Zoom. Full screen. Good, so today we want to talk about share trading a little bit. We haven't talked about shares at all. And later in the class we talk about short selling. And I think we will be good in time too, because I deleted more slides. These are the readings for that one. The reading itself is much more detailed what we want to cover in class, so you can ignore some sections there too. So today we want to talk about ordinary shares, preference shares. I'll explain that in a second. We will look a little bit at IPOs, share trading itself, talk a little bit about indices, and then this one here is the tricky part of today's class, short selling, covered and naked. Yes? How did that happen? It's only one side changed. Okay, thank you. Good. Right. So just an overview. First of all, what is shares and when do we start really talking about shares? So shares can be all kinds of stuff. You can have, for example, if you make a company with your friend, each of you can have a share of that company 50-50. Everybody has 50%. But that is not usually what we mean by shares. When we talk about shares, we mainly mean equity securities. So once you've got a share that is really tradable in the share market, that's where it's becoming interesting for us. So that's the reason why we've got a timeline here from a very small company to a very large publicly owned company. So how does that work? In general, you start companies with your own internal equity, so your own saving. That's how you can start a small, tiny company, just with your own name, with your own business idea, with your friends. You use your own funds, personal funds. You might ask your family and friends to invest a little bit into your company too, right? So this is not actually, this could be like Facebook in its first days, right? So if you watch the movie, The Network, when they really started out, they do it with their own computer, of course, the first few days, first few years possibly even, right? Then if they expand, they first use their own money and possibly let their family join in. But sooner or later, a company hopefully gets bigger and they try to get external investors in. And these are often so-called business angels and venture capital. So there's this TV series, what's it called? Shark Pool, Shark something? Shark? Tank, thank you. Shark Tank, thank you very much. So Shark Tank, that's exactly the idea here. People started with their initial funds themselves. They've got a good idea. They got the business going, but now they want to grow much bigger and they need more money to expand. And then they're looking for bigger investors. And that's exactly what happens in Shark Tank. So they're so-called business angels. These are successful business people that have spare cash, more or less, and they look for other smart people to invest in. So that's how the company starts growing. But then sooner or later, the company is so big that you want to start issuing real shares in the share market. And that is then so-called an initial public offering, an IPO, that we want to spend a little bit more time on. Then you get real shares happening here. And later on, if the company gets even bigger, they might want to get additional equity, additional funding in, and then it's called a seasoned offering. So they just increase the existing equity already. different types of shares. Ooh, that's not what I wanted to have here. This one here. I should have deleted this slide. So you can forget about this slide because that's all in this slide here already. So there's ordinary shares and preference shares. And when I was a student, most of the shares were ordinary shares and preference shares was a total exception. But when I prepared for this class, it turns out lots of recent tech IPOs like to use lots of preference shares. And you can see in a second why. What's the difference between these two different kinds of shares? So this one sounds ordinary, so it's like normal, and preference sounds like special, right? So preference sounds like they're the better ones. But that's not really quite clear. Both of them, you become a partial owner of the company. So you own part of the company. But here's one major difference. Ordinary shares have voting rights. That means you can elect the board, you can come to the General Assembly each year, and there's sometimes free food. But we personally, as small investors, don't have much of a vote. But large institutional investors that have a proper chunk of shares, they can really change the direction of the company by, for example, electing a different board. Also, the voting rights include that you can tell how much the management gets paid. So if you're not happy with their performance, you can kick them out via the board, or can just say, no, they shouldn't get a pay rise, because you're the owner of the company. Preference shares, however, have limited voting rights, usually none. So why would anybody in their right mind buy preference shares if you can't vote? The answer is in the next one. Usual shares, you might get dividends or you might not get dividends, depending on how the company is traveling. If the company is making lots of profits and management says, yes, we want to pay out those profits as dividends, you get dividends. But if the company is not doing well or management says, no, we want to keep all the profits in our company as retained earnings, then you don't get any dividends. No dividends whatsoever. And preference shares are different. Preference shares have an agreed upon dividends. So it might say you get, let's say, $10 each year. But then it sounds very much like a bond where you have an interest rate or a coupon of $10 each year. But we're talking about shares. So these are not really 100% fixed, because what happens there is if there's profits. If the company doesn't make any profits, you don't get any dividends. But there's something a little bit on top. If the next year the company is making super lots of profits, what usually happens is that you get your dividends, and on top you get the dividends from last year that they skipped, before anybody else gets paid here. That's the reason why they're called preference shares. You're giving preference first line when dividends are getting paid out here. Good, before I go to the other ones, I want to use this knowledge here already to say why tech companies use preference shares. Mark Zuckerberg, the boss of Facebook, is he happy about Facebook or doesn't he like Facebook? Like, is he personally attached to it? Or think of Elon Musk, Tesla. Are they just managers or do they feel like it's their baby? Baby, right? Now, if it's your baby, do you want to sell shares where other people have voting rights and can kick you out and get new management in? No, right? So that's the reason why lots of these new tech companies, they still have the founders, the people came up with that idea in management. And these founders don't want to have other people having lots of voting rights. Yes, they want to get their cash, right? They want to get their equity in, but they don't want to give up power. They want to be in charge of their own company. And that's the reason why they often issue preference shares nowadays. Right? That's typical for tech companies, because tech companies are very young and grew very fast. That's the reason why the initial founder is still in charge. Now you might think that it's a new thing for tech companies. Like in the past, I think Toyota, basically Toyota was founded by, if I'm not totally wrong, by Mr. Toyota himself. So in the old days, I'm quite sure he wouldn't like to give up lots of voting rights either. BMW is still in charge of, or family is mainly in charge of BMW. I think the Piech family, they own a huge chunk of BMW. They're not giving up their voting rights. But if you look at other companies like Daimler, so behind Mercedes, Westpac, there you don't have that one initial founder still being in charge, not wanting to share the voting rights, so they have much more ordinary shares. Good. What else is special about shares? Residual claim on assets, so that's important. Unlike the bonds, where there's a promise that you get repaid, shares, if the company goes bust, you really get only the leftovers. So everybody else gets paid first. If your company goes bust, first the workers get paid any kind of wages that haven't been paid out yet. Then all kinds of suppliers get paid, whatever they are owed. Then the bondholders get paid, whatever they hold. And only if there's nobody left over that company owes money to, then the shareholders get paid out whatever is left. So you're the very, very last one that gets paid if the company is going bust and is being liquidated. Preference shares, a little bit better. So preference shares get paid before the ordinary shares here. So there's a better chance to get something back if the company goes bust, if you have preference shares. And both of them have, of course, limited liability. That's typical for all securities. That basically means that the maximum that you as an investor in shares can lose is how much you've invested in shares. If you bought shares for $1,000, the worst thing that can happen is that the share price is going all the way down to zero, then you have lost $1,000. It's impossible that you get a phone call and they say, oh, the company's in trouble, we want to have $2,000 or $3,000 more from you. That can't happen, right? You're only liable for the amount of money that you paid for the share. That's what's meant by limited liability. Good, so much to preference shares. In the news, franked dividends. So currently, you might have watched Liberals and Labour. They're arguing a lot about dividends and franked dividends, dividend imputation. So how should the tax be done on dividends? Anybody is following that a little bit in the news? So always watching the news, good, right? So basically the current rule is there is a chance that if you have shares and you earn a low income, you get so-called franked dividends from the company, and then you get money from the tax office with these franked dividends. And that's what Labour is not very happy about. That people that have shares can get money from the Australian tax office. Cash out, they call it. Now, where is that coming from? What's the reason for that one? The idea here is the following. Let's say you own a company and that makes $100 profits, and you as the owner get these profits, right? Or you should earn these profits, and the company is paying 30% tax. After tax, the company's profits are now $70. Let's say the company is paying these $70 to you. So you have $70 income. And your personal tax rate is 37%. How much tax should you pay? Just try out with your calculator, I'll do that too, and call in numbers. Doesn't matter if it's right or wrong number. So, anybody calculated anything? Nobody wants to volunteer. So what I calculated just now is I took 37% of $70 here. And that gives me 25.9. We just rounded up to 26. It's easier to calculate. $26. So if I'm paying $26 on my $70 dividends, I get out $44 after tax. But where is the problem now? Tax twice, exactly, right? Because $100 all of a sudden become $44. And that is way more than 37% tax. That is much closer to 56% tax. And that was not intended, right? The government said I should pay 37%, but now because I'm the owner of the company and they already paid 30% tax, if they're just taxing my dividends fully again, I get charged tax twice. And in my example here, I ended up to pay 56% in tax, and that's way too much. Right? So really what I should pay is 37 on the 100 here. Right? And what they can do, for example, is that's what the franking dividends are for. They're saying, well, I should pay all up $37 in tax. The company paid for me already $30 in tax. So left over for me to pay is only $7. That's the whole idea of dividend imputation or franked dividends, that I don't get paid tax twice. Makes sense, right? I mean, why should I pay much more tax simply because I'm a company owner instead of earning my own money, right? I shouldn't pay tax twice. But here's the trick part. Let's imagine you are income poor. So you've got lots of shares, but this work you just didn't go to work. You were all year long in the Bahamas. You didn't have any official income apart from income from your dividends. Because you're so income poor, you didn't go to work at all, your tax rate is very low. You have to pay only 10% tax. Now let's see what happens now. If you should pay only 10% all up, that means on $100 you should have paid $10. The company already paid $30, so if you're using our franked dividends now, the tax department has to pay us back $20 in cash. And that's what Labour doesn't like, right? That's not a really good look. That somebody that owns lots of shares all of a sudden gets from the Australian government additional money. But from an economics point of view, it's kind of the right thing to do, right? Because we have a law here, the tax law said, if you didn't earn lots of money in that year, you should pay only 10% tax. And these guys here already paid 30% tax. They paid too much. So they should get money back. So from a logic point of view and an economic efficiency point of view, the current tax law is actually quite good. Right? From an equity point of view, people are going to argue, well, it really depends upon income poor, right? Somebody who has a lot of wealth, should you really pay them, tax them at a low rate? But it's a different question, right? It has nothing to do with dividend imputation or franked dividends. It just has to do how do you tax wealth, which is not part of our class. So for our class, it was just important for me, because it's currently in the news, that you roughly have an idea what does it mean, franked dividends and dividend imputation. The main kicker here is you don't get charged tax twice. Good, now let's go over to issues of shares. Issues of shares, so we use an investment bank. It's helping us if we are issuing shares for the first time. They're doing all this kind of stuff. I've got a little video clip for this one in a second. And we call this one an IPO, Initial Public Offering. And I want to show, oh, where's my clip? Do I need this one beforehand? Let's watch the video clip first. I think it's more interesting. Come on. Feel free to chit-chat to your neighbor till I get that running. I'm trying to get that running on this one. I think I did beforehand. Let's see. It doesn't want me to. But I logged in when I started. See, there's a tab here. That seems to work. Doesn't want to let me get outside. I really wanted to show you this one because otherwise it's all theory, which is less interesting. So unfortunately it doesn't show me quick enough. Let's see if you can see it like this a little bit at least. So they're talking about Dropbox. IPO, initial public offering. So this is the first time that Dropbox is selling real shares, not to private investors. We had that beforehand, that we had private investors already, but in the market. And that is really up to date because today is Wednesday. It's really a shame that that video is not running. So I have to tell you everything by myself now. So today is Wednesday. For the last few weeks, they did a so-called roadshow. That means that people from Dropbox, the CEO, CFO, and other hotshots from Dropbox went to major US cities and showed major potential financial buyers of shares how great their company is. They showed them all the books. They showed them what their technology is. They showed them how they believe how the company is growing and why people should buy shares in that company. They want to raise around $650 million in equity. So they're not selling the whole company because the whole company is actually worth several billion dollars. They just sell a small part of that company into the public market. Most of that company they want to keep for themselves. They're estimating that the share price should be $16 to $18. We don't know yet how much the share price is. So they're doing this advertisement travel, and that is a so-called roadshow. So they're showing off how great Facebook is. Dropbox. They will start trading, or the IPO will happen basically this Friday, as far as I know. Right? And this Wednesday afternoon, they will decide actually how much of a share they actually want to sell, because that's not fixed yet. They're saying, well, we want to get this much money in, but they didn't say anywhere, is that much money 10% of the company I can buy with 650? Or can I buy only 5% of that company with 650? They haven't told us yet. So Wednesday afternoon, American time, most likely they will tell us. Then we will get a better idea how much of that company is actually getting publicly sold, publicly traded. And then sold and traded will happen on Friday, this Friday. So it will be interesting to see if they really reach $16 to $18. Now here it says oversubscribed. What does that mean? They're doing this roadshow, and on the roadshow they do something that is called book building. Book building is basically they're taking out, just imagine like this, they're taking out a book and saying, okay, you think you want to buy this many shares, you think you want to buy this many shares. So they're trying to suss out the market, what kind of share price and what kind of percentage of the company they should sell. Because nobody knows yet. It has never been traded. It's the first time on Friday that it will be traded. So book building is kind of sensing the market, what's going on in the market. And that's what's going to be finished by this late afternoon. What else is in there? There will be, oversubscribed means when you have book building, they want to sell $650 million. And it turns out more people want to buy shares than they have estimated. So more people would like to spend even more than $650 million on these shares. They would like to buy more of these. That's called oversubscribed. By the way, just because they say it's oversubscribed and just because they say there's large interest in their company, it's not a guarantee that the share price will go up immediately afterwards. So everything that I'm saying now, don't necessarily use it for speculating and then come back next week and say, Axel said the share price will go up and now I've lost lots of money, right? This is not how it works. But it just says there's a lot of interest in their company. What else can I say? Underwriters, I wanted to say. See, it's a real shame that the video is not running because it said everything. So underwriters. Dropbox itself is of course not a bank, and Dropbox is not a financial expert. So they get financial experts to help them to issue these shares. And these helpers are usually investment banks. And because Dropbox is so big, with 650 million IPO, they have several investment banks lined up for them. And I think it's on the slide. They've got Goldman Sachs, Deutsche, and I have to cheat and look at the slide what else is there. So there's several banks helping them with these IPOs. And they can do that in several different ways. One of the ways is so-called underwriting. So it's kind of putting your signature on it. And the trick with the underwriting is that the bank kind of gives Dropbox a guarantee you will sell all your shares. Either we help you to sell all your shares in the market, and if there are shares left over that nobody wants to buy, we buy them off you. That's what the underwriting means. Underwriting guarantees that the investment banks make sure that all the shares get sold or any leftover shares are bought by the banks themselves. That's underwriting. Good, let's get back onto the slides. That's a real shame that these things don't work. I especially looked them all up for today's class. Book building, so we've got IPO Roadshow, book building, underwriter covered. I really wanted to show you this one too, because it's the so-called prospectus. Prospectus means it's a printout that is showing all the important information about that IPO. I'm trying to get that running here quick. Yes, that one works a bit better. So when we think about prospectus in the textbooks, we always think about a little document, but it's actually a huge document, and there's no way that anybody should or will read that. I think only professional investors read through the whole document, and most likely even they don't. So what do we have here? So this is the official document by Dropbox. That's a prospectus. That's a little bit interesting. So I'm not selling their shares in New York or somewhere in Silicon Valley, San Francisco, but the company itself is set up in Delaware. And the reason why they're set up in Delaware, as many American companies, is Delaware has very advantageous tax laws. So it's good for them to have low taxes. And I think the judges, so if Dropbox ever gets sued, they have to get sued in Delaware, and the judges there might be favorable to companies too. So lots of American companies have the headquarters, not the physical headquarters, but the paper headquarters in Delaware. So there's all kinds of stuff on here. What is interesting? One of the things that I found quite interesting was, let me see. Remember how I said in the past things used to be usually ordinary shares, and nowadays a tech company likes to use lots of preference shares. So they don't call these preference shares here, but look at this one. They've got shares class A, shares class B, shares class C, and so on. And you can imagine each class has different kind of rights attached to it, more or less voting rights. So then it's selling one type of share, but lots of different ones. Then what else do you find interesting? Look at this one. Share price will be between dollar space and dollar space. And I just downloaded that, I think, 2 days ago, so it's fairly fresh. Seems weird, right? But remember, I said they're still on the roadshow doing book building. They're still trying to get the pulse of the market, how things are going. So they haven't really decided yet what the share price should roughly be on Friday. So they will put these numbers in on the last minute, basically, possibly tonight. Here, also interesting, they're giving us no information whatsoever how many shares they're selling and for what kind of company share. We don't know. Ooh. We don't know anything of these things yet. Everything is left open here. Here it says something interesting though, underwriters expected to deliver share against payments in New York. So it's at the New York Stock Exchange, even though it's headquartered in Delaware. Goldman Sachs, Morgan, Deutsche, Allen, what else do we have interesting here? Macquarie is interesting for us in Australia. So there's several banks basically sharing all that workload. And as again, they are underwriting. That means the shares get sold guaranteed. Fancy pictures, a little bit, right? So all over the news there's these kinds of information, how great Dropbox is, but that doesn't really tell us anything about the share, or the interesting part for me at least. And look at how many pages, 182. Have fun reading all that stuff, right? But of course, if you really want to know what you're buying, you should read it. But I don't think that many people will. Anything interesting in here? So this is all marketing slang, right? How great they are, blah, blah, blah. Fantastic revenues. I think that was the most important one, was that? Voting rights, look at these. Class A, entitled to 1 vote per share, so that's a normal one, 1 vote per share. B, 10 votes per share. Now that's a bit interesting, right? What do you reckon who's buying the B shares or who keeps the B shares? The initial owners, right? So the most likely the A shares go into the market and the C shares, I guess, as well, no voting rights at all. But the B shares, which get 10 votes, so much, much more impact, I think the owners simply keep most of those. Blah, 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 lots of fine print, conflict of interest. Sorry?
So the price for Class A, Class B, Class C is the same?
Think for yourself. If one has, it doesn't say how many dividends you get, right? Let's presume you get the same dividends and one has more rights than the other one. What would happen to the price? Different prices, right? Yes. So with preference shares, with this one here, no voting rights, but therefore you might get a fixed dividend. Then it's a question mark. The price could be higher or could be lower, right? Depends upon what the market wants. If the market is really keen on fixed dividends, the price goes up. If the market is more interested in voting rights, price goes down. Or what could also be a company that has lots of profits all the time anyway. You don't need the fixed dividends. You're happy with the normal dividends. A company like Dropbox, though, lots of these tech companies, are they famous for their dividends? If you have to take a guess, a company that is growing very fast but reinvests lots of its money, are they paying high dividends or low dividends? Low dividends, right? Lots of retained earnings. So it's really your own investment strategy if you want to go with capital growth, that the share price is going up, or if you rather get paid out dividends. Different investors have different tastes. So we can't 100% say if it's higher or lower, but most likely there are different prices. There's no reason why the price should be the same. Good, let's jump back to the class. Hey. So we've got the most important things here covered. Feel free to click on this one for yourself at home as well. So this one here is a 2-minute video. That just makes it more interesting. If you look at this one again too, just follow maybe in the news. I'm sure it will be in Friday's news. Over the next few days, there will be big news, the Dropbox IPO. Good. So we basically covered most of these things here already, right? And there's different ways to sell these shares. Often it's a fixed price auction. So basically they're saying this is the price. We want to sell the shares at, let's say, $17, and then people can put up their hand and say how many they want to buy. Book building we already covered. That's there too. On-market book building. I wanted to delete this one. So this is a new thing where the ASX is basically helping you online to find out a reasonable price for your new IPO. What else do we have here? That's here one, right? So where people are just bidding basically for the shares before the shares really get sold, and then you get a feeling for how the market is. So here, this one is important. Underwriting guarantees that you can sell all the shares. So this is what the investment banks do. They underwrite your issue. The alternative is that you make a contract with the investment bank best offer basis. So they're just saying we're trying our best. And if the shares don't get sold, tough luck. Then Dropbox doesn't get all the $650 million they wanted. If they sell less shares, they simply get less. And the investment bank says, sorry, I did my best effort, we can't do any better. And this is the reason why lots of you might want to work later on in investment banking. 5 to 10% fees. So all these investment banks that help Dropbox with their IPO, remember the IPO is $650 million. So in fees, they get roughly $65 million in fees. And it's not thousands of people working on an IPO, right? It's a few teams. So you can imagine what the return for these teams is. So I remember when I was working in the bank and going for a lunch break, and there was a new Porsche driving by, then the colleague said, "Oh, look, somebody helped with the new IPO." Right? So they're getting quite a bit of, there's a good return for the investment bank and usually good return for people that work on these teams as well. What do I have in here? Seasoned equity offerings. So that is for old companies that are already traded on the market if they're selling some additional shares. Dividend reinvestment plans. Used to create new shares. Okay, so instead of paying out your dividends, you simply get new shares. Similar to just retained earnings. So there's not really anything magic to that one. Rights issue is a little bit more interesting. So that is when they're issuing really new shares. And then the question mark is, well, the old shareholders, let's say they owned 100% of the company. What's the problem if you're selling new shares now? Diluted, exactly, right? So they used to own the whole company, 100%. If you sell new shares to somebody else, let's say 20% of the company is going to somebody else, then they don't own 100%, they own only 80%. Is that fair? If you own 100%, are you happy if part of that is just got sold to somebody else without your involvement? Surely not, right? And that's the reason why it's called rights issue. I'm just touching the surface there. So that means that old shareholders have the first right to buy the new shares. And these rights, they can sell to somebody else. So in my example, if you issue 20% new shares, so the 20% of the company is going to somebody else, you have the right to buy this, and only if you give your right to somebody else, they're able to buy the new shares. And therefore these rights are valuable. And the value of these rights turns out is exactly offsetting any kind of loss or pain that you've got from the dilution. But we don't do the math in this class for this, right? It's another 40 minutes otherwise. But just keep in mind here, actually it's worth writing onto this slide too. So old shareholders have the first right for new shares. And private placement is that instead of doing it in general public, selling the shares to anybody, you have kind of a private deal with somebody. So that happens usually when you have very, very large investors. Somebody like Warren Buffett, for example, might have an interest in the company, and then they create new shares especially for him. Of course, they have to get the okay from the existing shareholders first, but then these shares are not sold to anybody, but they're specifically sold to him. Trading of shares. Should we do that now before the break? Let me just see. Yep, let's do a little bit before the break, and then you deserve to break. So there's plenty of opportunity here to get things mixed up. So this is from Combank, a screenshot of their own share trading. And what we can see here is 1 million different numbers. Now what does that mean? Firstly, we have buyers of shares, and we also have sellers of shares. So let's start with this one down here. Buyers of shares and sellers of shares. Now, who should be first in line when they are buying shares? Who should get shares first? The one with a high price or the one with a low price? High price, right? That's the reason why they're ordered here, and the one with the highest price is sitting on top. So he's getting served shares first. If anybody wants to sell shares, he's the one first in line who might get shares. And he has a limit. He says, I don't want to buy shares for $60, $70, $80 or for infinite amounts of dollars. He says, the maximum I want to pay for one share is $49.55. And for sellers, of course, it's the opposite. So if you rank all the sellers, who should have the right to sell the shares first? The one that wants a lot of money or the one that is happy with the cheap price? Cheap price. That's the reason why here the order is the other way around. The cheapest one comes first. And what we can see here is they don't match, right? So he wants to pay not more than $49.55. He says, I want to have at least $49.59. So there's no trade in that moment. And that's why we can look up here. So up here we can see the current bid, so how much people are willing to buy, and the current offer, how much people are willing to accept when they offer shares, which is a higher number. And here we see last, that is the last trade that happened. That is before this screen was available, just a few seconds ago. The last time that a buyer and a seller met and agreed on a price was this price here. Change, that is the price change compared to the price before the last price. So you know share price can change any time. Open is how this day opened. So the whole day started at 49.27. So since then it went up. The highest was 49.66 on that day, up to this time. The lowest was 49.27 again, and volume was how many shares had been traded. By the way, here we can also see the volume, the quantity. So people don't only say, I want to buy shares at 49.55, but they of course have to say also, how many shares do I want to buy, right? Not infinite amounts of money. Now, I personally always mix up bid and offer. I can never remember which one is the buying of the shares and which one is the selling of the shares. Always have trouble with this one. But there's a very, very simple rule. If you could buy shares cheaper than you can sell them, what would you do all day long? Buy, sell, sell, buy, sell, sell, sell. Don't come to this class, right? Do that all day long, and by the end of the day, you're rich. So is it ever possible that you can buy shares cheaper than you can sell them in the same moment? Totally impossible, right? So it's always that the buying one, did I say that correctly? The buying, I can see it already, I'll mix things up. Buying of shares should be more expensive than selling of shares. And if you want to buy shares, you have to buy shares, of course, of the seller. Sorry, that was not a good explanation, right? So it's slightly different. The seller is not willing to give you shares very cheaply. The seller always wants to have the higher number. And the buyer always wants to pay the low number. This is the way to memorize that too. Or I always say here, the bank always wins. If you imagine that this one is the bank here and you want to buy shares, you are not able to buy the shares cheap and sell them to the bank expensive. That is of course true later when we talk about foreign exchange. On the foreign exchange, you also have the bid and offer. It's the same rule, right? If you want to buy something here, it's going to cost you the higher amount. If you want to sell something here, you get the lesser amount. Otherwise, you could get rich for nothing, which is not possible. Good, and since I like to mix things up already now, I think it's a good time for a break. And after the break, we play around with these numbers a little bit more and do practical examples. Let's make a 10-minute break. So 12 past, let's continue. Suppose the trader, or it's easier, just imagine you. You want to buy 1,000 Commonwealth Bank shares at market. Now what does that mean at market? That means you don't care how much they cost. You just say, I want 1,000 shares, for sure. So now we have to see what kind of price would you get. If you want to buy 1,000 shares, do you have to look at the buy prices or do you have to look at the sell prices? Sell, right? Because you have to buy it off a seller. So we look at these prices. So that's the first price that we see here, 49.59. We get some shares, but we want to buy 1,000 shares. This guy here, is he selling us 1,000 shares at that price? No, that's the tricky part here. Only 290 shares we get at 49.59. That means we have 710 shares, if my math is correct, left over. And now we have to check the next seller. So this seller is now out of the market. We can cancel him out. The next one, 49.60 now we have to pay. And we want to buy 710 shares. There's enough shares here. So we can get the leftover 710 shares at 49.60. So if you ever put a market order in, it could be that you get different kind of pricing. That can happen with limit pricing too. So there's no guarantee that you get one single price. How does this table change now? So this guy flies out. He sold all his shares. From this one we have left over, I can't do that quick enough in my head, 1,562 minus 710. That is how many shares are left over for him, right? That is how the table will change. Good, so that is, there's a number here, this many shares will be left over on the top. That's the first one. Now let's do another one. Suppose an at market sell order, and we pretend this thing didn't happen, otherwise it's getting too difficult. So if I want to sell 2,000 shares at market, who do I sell them to? These guys or these guys? Buyer, right? So we have to look at these. 2,000 shares. The first one in line here is this guy, 49.55. So the shares are getting sold to him. I wanted to sell, I think 2,000 it was. He wants to buy 12,000. So that's enough to cover my 2,000. So I get all the shares, no, I sell all the shares at 49.55. And this table will change towards 10,299. What else will change? Let's see. The bid will stay the same. The offer, if you pretend this didn't happen, stays the same too. The last will change. Right? It will not be this number anymore, but last will now become the last trade. That will happen. Anything else interesting? And the volume increases, of course, right? So the 2,000 in volume goes on top of here as well. Good, got that covered. At limit orders. By the way, I think I told you the story already that I bought an index fund once, or shares in an index fund, and I did it at market. Did I tell you that story? And what went wrong for me? What happens is the market is very, very thin. If you have seller, he wants to sell only 1, and he wants to sell 100. Which price do you get then for most of your shares if you buy 100 shares? You get one at this price, one at that price, 1, and then you get most of your shares at that really expensive price. Right? So if you are the only buyer in the market and you say, I don't care how much the shares cost, and the market is thin, means there's very few people here wanting to sell. Very dangerous, right? So I ended up paying way too much for my shares on that day. You can literally see it still in a peak, unfortunately, and if you look at the charts. So be very careful. We teach in finance often that the markets, financial markets work perfectly well and they're very deep and liquid. That's not really true on all the markets, right? So on the major shares and bonds it's true, but there's plenty of shares and index funds out there that are not liquid at all. Good. And because it's potentially not liquid, you want to be safe and make at limit prices. That means you don't want to pay too much or you don't want to sell at a too low price. So this guy here, he wants to sell 1,000 of shares at this limit price, 49.54. And we have to see where he's going into the ranking, right? So for the seller, which one goes on top? The one that is willing to sell at the lowest prices or the highest price? Lowest, right? And we said 49.54, which would have been the lowest out of all these. So he comes on the very top with whatever, how many shares he wants to sell. So he's coming on the top ranking here now. And 49.54, if you compare that to this price here, what magic trick might also happen? Is he able to sell? Yes, he's able to sell, right? So he's able to sell, there will be a match with a buyer here, and how many, I forgot how many that was, 1,000, so there's enough buying interest here, he can sell all his shares. Now here's an interesting question that I had to look up myself. He's willing to pay 55 cents, the other guy was willing to sell at 54 cents. What's going to be the price? 55, very good. And how did you know? Very good. Yes, 55. So the reason is there's kind of a promise to do that at the best. Let me think. Is that actually true? Yes. So if you put your order in, the limit order, the freshest order, you said, I'm willing to sell my shares at any price that is better than 54. I won't sell below 54. And you make that contract with the bank now that they're looking for the best potential buyer for you and the best price for you. And the best price that is in the market at that moment is 55. That's the reason why you get it. Now you might want to wait a second. This guy here, didn't he have a contract with the bank too, that they're looking for the best price for him too? That's true, but when he put his in, there was no 54 at the time. I hope I didn't mix these things up. I especially looked them up before class. I think we did it right. So that's the reason why it is in this case here 55, because the last guy that said, I want to have the best price, that's the way it goes. If I mix it up, not a total disaster. So I wouldn't ask that nitty-gritty in the exam. So that was this guy. Now let's see, somebody wants to sell 1,000 at limit. 49, 59, 50. Let's see where we should put him in. So he wants to sell. We said the cheapest seller goes on top, but he had 59.50, so he's not the cheapest, right? So he's not taking rank number 1, but he goes in between the two with whatever many shares he wanted to sell. I think you get the hang of it, right? So you have to first decide on which side are they going, selling or buying, and then you have to do the order. Sellers, the cheapest seller goes in the front, and the highest buyer goes also here in the front. And then they either match or they don't match. And when they match, you have to watch the quantities here as well. I'm sorry for that blinking screen, but there's not much I can do about that one. Good, got that covered. Clearing and regulation. So here I got a little bit detail because I've got a banking background, and when I was working in the bank, there's a big difference between clearing and settlement. And initially it sounds like the same, lots of textbooks treat it the same. It's very, very similar, but I think it helps a little bit to understand a small difference there. So clearing is basically the process where you make clear who owes who what. So for example, in the example beforehand, if I get matched with the other buyer, I as a seller get matched with a buyer, the clearing is saying, okay, these two have a deal now. These two have a deal at this price for this many shares. And that's what we will do. That's called clearing. We make clear who's doing what deal with whom and who should pay. So I'm, as a seller, should deliver then the shares. And he, as a buyer, should give me money for the shares. But we don't do that in the same second. When we do the clearing, we just decide who should do what. We haven't done it yet. Doing it is settlement. If I'm giving him the shares, or give the shares on the computer trade onto his account, and I receive money from him, then we are settled. Then we don't have any more business to do with each other. Everything is settled now. Like the dust settles, it's all done. That's what settlement means. And in Australia currently, there's a time difference between these two things, between clearing and settlement. So if you buy shares today, you actually happen to get them only 2 days later. Also, you have to pay only 2 days later. And if you sell shares, you get your money only 2 days later. That's the current state of the things. Hopefully in the future it won't take 2 days. I really don't know why they still have 2 days. Right nowadays we've had so fast computers, it really shouldn't take that long. And maybe we're going in the right direction because currently they are doing more or less a test run with blockchains. So the clearing center, the so-called clearing house that is doing all that clearing stuff here, it's called CHESS. You don't have to memorize these things, right? But there's this company, CHESS, that is doing the clearing in the Australian share market. They're using an older technology and they're going to switch over to blockchains. And I'm quite sure if you're big on Bitcoin and cryptocurrencies and the IT guys, they're going to say, see, the Australian ASX, they're using Bitcoins and they're using blockchain. Slowly, right? Blockchain is the technology. It's like just a certain kind of computer code. Bitcoin is also using blockchain, but Bitcoin and blockchain is not the same, right? It's like saying Mercedes and car. So if the Australian government is buying cars, doesn't mean that they're buying Mercedes, right? So there's a link between them, but it's not the same thing. And it's similar here too. So they're using blockchains, but they don't need any Bitcoins or no other cryptocurrencies either. They're doing their own thing. And to be honest, I've read up about it. It looks a bit like a test run. So we will see how well that actually works in the near future. Hopefully it makes things faster that the 2 days disappear. Share price indices. So what's an index? Don't get stressed with the formulas here. You don't have to calculate them. So basically, we want to get a feeling not only how is Facebook going today, how's Dropbox going next week, how is separate shares going at certain times, but we want to see how's the market in total going. And that's what we need an index for. Now the question though that comes there is, well, there's some bigger companies and some smaller companies in the market. There's, for example, Amazon, fairly big as far as I know in the market. And there might be, what is the company that's a bit smaller? I think Tesla is fairly big already nowadays too. Campbell's Soup, I think they're not that big, right? Or Kraft Foods. So they're in the market too. But if one share has one company is much bigger in the market than another company, it would be unfair to just plonk the two prices together and divide it by 2, right? And that's what they're doing here. So they're multiplying the quantities or the share that it's got in the market with the share price. So if your company by market capitalization, does it say there, Q's market capitalization? You can imagine it though. So it's market capitalization. Actually, it even works if you take the total quantity of shares. I think that's working too. So the total quantity of shares that you've got in the market times the price in the market, and I stands for each company. So you do that for Amazon, then you get the total amount of Amazon share value. Market capitalization is also called. Do the same with Kraft, get the total amount of Kraft. Do the same with all the other ones, right? So then you get the total value of all these companies and you add them all up. And then you divide that by this divisor here. And in this divisor here, you can see we've got almost the same thing here, right? We've got also price times quantity. But the difference is this is at time 0, so when you started the index. Right? Let's say you started the index 10 years ago, you do it at this time. And if the share price didn't change, so if you divide this one by this one and all the share prices are the same, the index would be simply sitting at 1, for example. Right? It wouldn't have changed. But if the share prices here increase, you can imagine the index going up. When the share price is decreasing, the share price is coming down. And then they also have this one here, index. So this is just to get a nice value in the starting point. So for example, here in the past, they wanted the index to start at 500. So they divided it by such a number. No, sorry, I didn't do that right. Usually the index should start at 100. So they divided in the very beginning by such a number, the starting date here, that this one becomes 100 at time 0. And then you basically go from 100 up, down, up, down. Good. What else do we have in here? So once in a while, the composition is changing too. So for example, a company might go bust. So they're falling out of the index. Then you would have, of course, a bit of a problem, because if a company falls out of this one here, all of a sudden the top of that fraction becomes smaller. But the bottom of the fraction, the divisor, of course, stays the same, because these are all old data from the starting point. So that would look like this. The index goes up and up and up and up, and all of a sudden it drops. Is that a good reflection of what happened in the market? Did the market really drop just because one company was pulled out of that index? It's bad for that one company, right? But most likely the company the day before it was worth almost 0 anyway. Do I shoot myself in the foot? Yes. If I do it like that, I shoot myself in the foot. So if you pull out a company that had a positive value here beforehand, and you just pull it out of the index, it doesn't mean that the market altogether fell, right? You just changed the index. And that's, of course, a problem. That's the reason why in that moment they're adjusting the index. So they basically cut that index there in the 2 halves, and they glue them mathematically together at the same level again, so you can't see it. That's what's meant here by changing composition of the index. You change the ranking of all, so you make the other companies more important. Same thing if you put in a new company. Right? If you put in a new company in, if you don't do anything with the math, the index would jump up all of a sudden. And it would like, oh, the market is doing especially good today. Which is not really true. You just put in a new company. So you cut the index then in 2 halves and pull the new half down so it matches nicely to the old one again. Don't stress about that stuff. We didn't do the detailed math for this one here, and I wouldn't expect you to calculate a detailed index and to fix up things, right? It's just to keep in the back of your head if you ever hear new companies coming in and out, and they say in news they adjusted the index, that's all that they're doing, that you get a nice smooth index here. Continuity, right? You want to have it smooth. Not day by day smooth, but smooth if you change companies. Good. We've got all kinds of index, the Dow Jones in Australia, S&P ASX 500, I think it's much more interesting if I show you one. So this is the All Ordinaries index, currently sitting at 6,000. Let's see if we take much longer times. Ooh, I picked a good time. That was not even planned. Look at this one. Right? Because some people always say if you hold shares for a really, really long time, it's much safer. Right? Shares go up and down from day to day, but if you hold for a very long time, shares are very safe. Many people say that. Now, is that really true? Look at these guys here. If they bought shares in May 2008, first, of course, massive shock here, right? What do we have here? Look at these numbers. 5,700. 3,200. Congratulations for your investment, right? You lost almost half of your money if you've done that. And now remember, don't worry, just hold that for a long time, we'll be fine again. Look how long these guys had to wait, right, till it's coming back up again. 2008, 2015, that's quite a long time. And then they're just breaking even again, right? Now, of course, what might have happened here is they might have earned dividends in the meantime, so it's not that bad. But still, if I would do the one for Tokyo, I think it was down even for a longer time, right? So be careful. Shares on average, it's true for very long periods of time, do earn a decent return on average, but it's still risky, right? I mean, if you in between wanted to buy a new car here, wanted to go on a trip, on your world trip, want to buy a house or something, and you have to sell these shares, how painful that would have been, right? So shares are risky. We can see that here in the index. And of course, from monthly, intraday, so even within a day, there's quite a bit of fluctuation here. Good. And that is basically the reflection of what we had just before. In the buying and selling, people put in a limit price, selling, buying orders in, people get matched, and the prices of individual shares change all the time, and hence the price of the index changes all the time too. Good. Grayed out means I don't want to talk much about it. This is just, not to talk about it at all. Share lending. Now, we know we can profit from share prices. If share prices goes up, of course we can profit quite easily. You buy shares today cheap, you wait, the share price goes up, you sell them expensive, right? By the way, it's not as easy because you don't know if the share price really goes up. But if you believe share price goes up, you can make a profit like that. But this is the interesting part. Let's say you strongly believe the share price will go down over the next week. And you're really, really, really smart, or you can foresee the future, which science shows nobody can see into the future. But for whatever reason, let's say you've got insider information when you go to jail too, if you use them, right? But just as an example, if you have got insider information, you're sure these shares will fall. How can you possibly make a profit out of that knowledge that you've got? If share prices go up, you should buy today and sell in the future. So the logic is if share prices go down, you sell today and you buy in the future, just the opposite. But that's of course weird, right? I mean, how can you sell shares that you don't own? And that is called short selling. You're selling shares that you actually don't even own. Sounds very weird, right? Lots of politicians hate it as well. Companies sometimes hate it as well if their shares are short sold. But in general, it's nothing next evil by it. So short selling, these are the laws. You don't have to know them by heart or anything or memorize. I just want to emphasize two things here. There's so-called naked short selling and covered short selling. Very easy to remember these in my opinion. So naked short selling is if you literally don't have any shares to cover yourself up, right? So I'll make a little picture, then it's easier for you to remember what I'm doing here. So this way I'm covered. This way I'm naked, right? So if you have the shares, you're covered. If you don't have the shares, you're naked. Naked short selling used to be allowed. So especially in America before the global financial crisis, lots of economists, lots of finance people say, no, let the market do what they want. If some people strongly believe that prices will go down, they should be allowed to sell shares they don't even have, right? They should be allowed to do these bets. But it's very, very dangerous because if you sell something, you kind of promise to deliver these shares. And if you don't even have them, things can go wrong, right? If the share price doesn't go down, but share price goes up by a lot, you might not be able to buy these shares and you might not be able to deliver them, even though you promised to sell. And that's a big problem. That's the reason why naked short selling nowadays is forbidden, right? So the regulators here said no more naked short selling. Only covered short selling is allowed. And that's the reason why we have so-called lending arrangements. So if you don't have any shares, but you want to sell shares, what you do is you borrow shares from somebody else. Say, listen, can I borrow your shares for a week? I'll pay you $20. I give them back to you in 1 week time. Just give them for me 2 weeks. So now you've got the shares. You didn't buy them. You just borrowed them. You sell them in the market. If you're lucky, the share price goes down. I think I've got a number example. Let's go straight to the number example. Speculation that goes well. So you borrow 100 shares. You sell them, let's say, at $50. You sell all your shares at $50, so you get $5,000 in. Now you were correct. Next week, the share price is actually lower. It's only $30. Now you buy 100 shares back. You pay for them 30 times 100, $3,000. Now you've got the shares again back. You give the new shares that you bought back to the guy where you bought them initially from. Say, here are your shares. Thank you for giving them for me to a week. And now you basically earned 5,000 minus 3,000 that you had to lay out for the buying, minus some fees, of course, for the borrowing. But you made quite a bit of profit. And you made the profit from a share price 4. Share price were going down, and you made a profit. That's the whole point of short selling. Good, let me see what else I wanted to take out of this one. So you get temporary, if you borrow these, you get the legal rights. Of course, you have to return them sooner or later. You pay a fee, makes perfect sense too. Payment of, yes, this one is interesting too. Because you borrowed these shares only. You're not the real owner of these shares. So if there's any dividends paid in between, the dividends should go to the actual owner of the shares. Right? So you have to make sure that he's getting paid the dividends. That's your problem too, if there's any dividends due in between. Even though the borrower may not receive it. Yes. So it doesn't matter if you receive the dividends or not. So if you don't have the shares, so you don't give the dividends. You have to make sure that you give the lender the dividends because he was the real owner of the shares. Transfer of ownership, so you need to have the legal title. Got all that stuff. No price is paid. So you're paying only a fee. You're not buying these shares when we have a share lending arrangement, right? So if these shares are worth, in my example before, $50, you're not buying them. You're just paying a fee, a few cents or a few dollars. Then a little nitty-gritty here. So the original order can recall. I'm quite sure you get a certain contractual time that you can keep them. Advantages. Now, why do we do all that stuff? So the original owner of these shares, there's somebody there that has these shares. Possibly he wants to have these shares for a very, very long time, for 5 or 10 years. Insurance companies, for example, they invest for very, very long times. And the shares are just sitting there, earning dividends, don't do anything else. If you lend them out to other people, you get additional fees in. So you get money almost for nothing, right? So borrowing fees, that's very nice. And you don't lose any of the dividends either because you have the rights to still get the dividends, even though you don't have the paper in your hand anymore. Now for the borrower, of course, the short seller is hoping to make a profit. There's no guarantee that they're making a profit. And hedges, that's interesting as well. So you might have, for whatever reason, a position in the market where it is bad for you if the share price is falling. For example, you own, and you could sell your own shares too. But let's say you, here's an idea. Let's say you've got a really rich uncle and he gave you a portfolio of shares, Westpac shares. But because you can't be trusted, you don't have your diploma yet, right? You haven't finished your degree. So he says you're allowed to touch these shares only once you finish your degree. But you're afraid that the share price is dropping by the time you finish your degree. So you're afraid of share prices dropping. That's your downside risk. Now here comes the beauty. If you're going short and the share price is dropping, you're making a profit on your short. That is exactly counterbalancing the loss on this one. So it's like an insurance. It's like a hedge against this one. So the whole point, if you didn't fully understand what I just said, right? The whole point here is if you're short selling, it's not always speculation. Maybe it's just a counter position to something else that you have in your portfolio. Maybe it's just an insurance against some share price drop. So that was when things go well. Things can go, of course, wrong too, right? So you have borrowed the shares, just as an example before, 100 shares you have borrowed. You sold them in the market for $50, so you earn $5,000 on the spot. Now next week comes, the guy says, listen, 100 shares, I want them back. He said, sure, I'll get you the 100 shares back. $60 they cost in the market. 100 times 60 means you have to pay $6,000 to buy the shares back in the market, to give them back to the guy where you bought them from. And now you're minus 1,000, plus the fees on top too. Right? So that's the danger with short selling. Good, got that one. Why should we allow it for short selling, or why should we disallow it? So I already said naked short selling, if people don't even have the piece of paper, can disrupt the market because they simply might not be able to deliver at selling date, right? So then people might say, yes, I want to sell lots of shares, and they find a buyer, say, yes, deal done, and then they can't actually deliver the next day the shares, or T+2, they can't deliver the shares in 2 days, and the whole market breaks down. That's no good. But if you're covered, that might work. Some people still don't like it. Let's see at the advantages. Market liquidity. It basically means we have more buyers and sellers in the market, right? So let's say, for example, if Dropbox or Facebook, most of the shares are still within the company. And the company might simply not be willing to sell lots of shares, even if there's a chance that the share price might go down, right? They're just holding on to them. And if lots of people think like, no, wait a second, the share price of Facebook or Dropbox is way too high, we should sell them now because surely they fall down. Short selling enables other people that actually don't have shares yet to have a say. They say, no, we don't believe the market price is correct. I believe the market price is going to fall down. Hence, I short sell these shares. So it makes the market more liquid. There's more sellers. Similar here, price efficiency. So basically the price is better reflecting what everybody in the market believes, not only the people that own these shares already. This is a disadvantage. Short selling makes price manipulation easier. So if you have a smaller company or a company that is not very well traded in a thin market, and all of a sudden somebody is borrowing thousands of shares and just dumps them into the market, then it's becoming like a self-fulfilling prophecy, right? Because all of a sudden there's so many shares sold, of course, then the market price starts dropping, right? That's market manipulation, and there was an old movie, I think in Wall Street, or one of those movies that they did this one. This is also not allowed if you do that on purpose, right? That's illegal to do, but it's hard to prove. What else do we have here? That's what I said here. So in general, you can do it, but provoking, so doing that on purpose, that is illegal. Good, I'm okay with timing today. So companies can get equity via equity finance by issuing shares. Well, that's interesting here. IPOs is for the first time, and seasoned offering is when it's doing later. Indices are just weighted average of share price portfolios. Then it's possible to gain from potential share price drops via short selling. Remember, naked short selling is forbidden, and you have to be covered. You have to have these shares. Good. I'm glad that I'm more on time this time. Next week, I've seen the slide for next week already. I was told to upload them earlier. I tried to do that, but I have to go over the slides a little bit more because next week we do a lot of math. There will be a lot of present value, future value, if you like, lots of math. That is what's hitting us over the next 2 weeks. So I tried to upload them earlier, that you can take a look at them already. Good. Thank you very much.